How can you identify a market trough in market cycles? Imagine standing at the edge of a long, downward slope in the market, wondering when it will level off and start climbing again. That point where prices stop falling and begin to stabilize or rise is called a market trough. Recognizing this moment is key for investors who want to buy assets at lower prices before the market moves upward again. But how do you spot it? Let's explore some clear signs and methods to identify a market trough. First, look at price action patterns on charts. During a downtrend, the lowest points are where selling pressure slows down. You might see double bottoms, which are to similar low points, or rounded bottoms that suggest a gradual reversal. These patterns often act as support levels, acting like a floor that prevents prices from dropping further. When prices hit these levels and start to bounce back, it could be a sign the market is reaching its lowest point. Next, technical indicators can help. Momentum oscillators like the relative strength index or the stochastic oscillator show when the market is oversold. When the RSI drops below 30 or the stochastic falls below 20, it indicates that selling might be overdone. This can be a signal that prices are ready to rebound. Also, if the price makes a new low but the indicator does not, it's called divergence and suggests weakening downward momentum, hinting at a possible trough. Volume analysis is another useful tool. During a downtrend, volume often declines, but as the market approaches a trough, volume may pick up because more buyers are entering. Indicators like the on-balance volume or the money flow index can confirm if buying interest is increasing at these low points. Trendline and moving average analysis also provide clues. When prices approach or bounce off long-term moving averages like the 50-day or 200-day simple moving average, it can act as a support level. If the moving averages flatten or turn upward after a decline, it signals the market might be bottoming out. Watch for the formation of higher lows and higher highs after a low point. This pattern shows the market is starting to recover and is a good sign the trough has been reached. It's also helpful to consider investor sentiment. When most investors are pessimistic and confidence is very low, contrarian investors see this as a buying opportunity. For practical use, combine these methods rather than relying on just one. This helps avoid false signals. Recognize that identifying a market trough allows you to plan your investment entries carefully, aiming to buy assets at lower prices before the market begins its upward move. Remember, understanding these signs within the broader market cycle helps you stay aligned with the natural phases of market growth and decline, improving your chances of making smarter investment decisions over time.